Avocap Africa Equity Special Fund offered a return of 54% in 11 months, meaning if you invested 100,000 Kenya shillings in the beginning or in when they launched or in June 2024, after 11 months, that takes us up to May this year 2025. So in 11 months, you had a return of 54,000 Kenya shillings. From now, you are 100,000 Kenya shillings investment. Those are massive returns, true? And if you have been with me here, you know the returns that we have been talking about, and most of the time, even the special funds, they offer around, if the highest is 20 something, but 54. That's a lot, yes? So let us see, where do they invest this money? How does this fund work? And how risky is this fund? Let's find this out. So to kick off this discussion, we start with the regulation and the management, okay? So the fund is managed by Avocap Asset Managers. Both the fund and the fund managers are regulated by Capital Market Authority, and the fund falls under the same category with money market funds, that is a collective investment scheme, but they have a totally different level of risk. And we're going to discuss that. So Arvocap Asset Managers were founded in 2023, and they officially entered the capital market with the launch of its fund or the funds in June 3rd, 2024. The capital market cap approved the registration of Avocap Unit Trust Scheme on May 15th, 2024, but they started operation in June 3rd, 2024, and this is for all the Avocap Unit Trust. And I know that we have discussed a few of those here. We have actually even discussed Almasi Fund, and if you're interested with that one, you can as well watch it. I'm going to leave the link in the description box. And for all these funds, they have been doing very well in the past 11 months since they were launched, that is in June 2024. And all these unit trusts, they have different levels of risk, and our focus today is Avocap Africa Equity Special Fund, so that we see how risky it is and how they invest the investors' money, okay? And maybe before we kick off the discussion about the equity fund, I want us to discuss about unit trust so that you can understand how this fund works. So ideally, for a unit trust, how it is structured, this is a fund that collects money from different investors, and they invest in different things to just make sure that you as an investor, you're getting some returns from it. So that is how unit trust usually works, or how they are structured. And ideally, for a unit trust, how it is supposed to operate, it's supposed to invest the money that it has collected from investors in different things, so that they can make sure that they are diversifying. So they don't invest in a single asset. So they invest in different assets to make sure you as an investor, your money is protected to some degree, okay? Now, as we have mentioned, that the fund has been in operation since June 2024, and in these 11 months, they have done a return of 54.33%, and I think it's very good for us to include the fees here so that we understand the returns better and see how much you actually got into your account. So this fund has an entry fee of 0.5% and doesn't have an exit fee. It has a 2% management fee, but I want you to note that the returns that they give, now the 54.33% is net of the initial fee and management fee. So the only fee that you are going to be paying here is the performance fee, which is charged on the returns. And I want us to maybe work with an example so that we understand how this works and we see real figures. And when I said the only fee that you're going to be paying here is the 20%, it doesn't mean that you have not paid the other fees. It's just that the returns that they have given, they have already deducted the management fee and also the initial or the entry fee, okay? So if you invested 100,000 Kenya shillings when the fund was launched, after 11 months, you got a 54.33% return on the investment, okay? So the now 54.33% of 100K will give us 54,330, and that is the gross return. So since the rate is less, the initial fee and management fee, we only deduct the 20% performance fee. So we do 20% of 54,330, meaning they deducted 10,866 as the performance fee. meaning your net returns would have been 43,464. That is what you got in your account if you withdrew at that particular time, and that is the time that they reported this particular return. All right, now I would like to ask you a question. I know we have a gut feeling even when it comes to investments. Sometimes back I used to ignore these gut feelings because I believed that in investment you only needed to look at the numbers, the facts, and the data. But later on, I came to realize that my gut feelings is as important as the numbers. And I remember my mentor once mentioned that sometimes your gut knows even before the numbers. And he told me that I shouldn't invest until I feel that the investment is right. That gut feeling. And today I completely agree. I don't want to invest where I won't find peace, where I can't find peace. I would like to know if you follow your guts in investment despite the numbers. Let me know in the comment section. Do you actually follow your guts when it comes to investment, or do you ignore them? And if at all you have ever ignored that gut feeling, have you ever lost some money that you felt some type of way when you started investing? I really like us to discuss this, because in as much as you're talking about how the fund works, how you invest, how looking at the numbers and looking at all these good returns, do we also rely on our gut feeling? Maybe just let me know in the comment section. And I would also like to know, what is your gut feeling telling you about this particular fund? Do you think it's a hidden gem or a very risky bet? Let me know in the comment section before we look at how risky the investment is, okay? I really appreciate your responses and appreciate your feedback, all right? Now, let's look at where they invest and how they make money. So this is an equity fund, and equity funds invest heavily in shares, and for this fund, as the name suggests, the Avocap Africa Equity Special Fund invests in African stock markets, and its strategy is to identify big, successful companies across the continent, the African continent. That's why they are called Avocap Africa Equity Fund. Yes, it also targets well-known Kenyan brands that have parent company or maybe subsidiaries performing better in other African stock markets. For example, if Safaricom has a subsidiary in Rwanda and its shares is performing better in Rwanda than in Nairobi Securities Exchange, the fund would choose now the stronger Rwandan stock market instead of the NSC. So beyond Kenya, this fund expands investment opportunities into industry that don't have publicly traded shares locally or stocks locally, such as maybe manufacturing, mining, and hospitality. Or even better, they are able to tap into sectors that do better, but maybe here in Kenya we have limited numbers of those companies listed in the NSC. Again, I will use Safaricom as an example. If maybe the telecommunication industry is doing well, we can only invest in Safaricom shares. But if the focus is in the whole continent, that is in Africa, they are able maybe now to identify or to invest in other telecommunication companies that are listed in other stock exchanges that are within Africa, okay? So in this case, if for example, the strategy is to invest maybe 10% of the invested money in the telecommunication companies, they won't be limited to investing all this amount or money, the 10% in a single company in the telecommunication industry, because now they'll be having options, because now we are looking at a wider coverage, or we are looking at Africa instead of looking at Kenya alone. So in short, it helps the investors diversify the investment across Africa and tap into stronger performing stocks and access sectors that are not readily available or are not available on the Nairobi Securities Exchange. And if you have been following me, you know diversification, especially in unit trust, is a very big deal. Actually, they are required to diversify. So when we are talking about markets that are outside Kenya, it even gives them an opportunity to diversify further. We are still waiting for the fund fact sheet for these funds, and my hope is that they will indicate their asset allocations. And since I know when it comes to shares, because they are buying and selling, meaning that it is very hard for them to give a detailed breakdown about the specific shares, but we would appreciate even a broader asset allocation snippet on how they actually invest the investors' money, to just have an idea of how well they have diversified the fund. So once the fund fact sheet is out, I will make sure that I make another video to just break this down. So make sure that you subscribe so that you don't miss out on those updates, all right? And before we discuss the risk involved in investing in this fund, let us talk about some of the important features that you need to know before going into this particular fund, okay? So for starters, this fund is denominated in ZARs, that is a South African rand. However, you have an option to invest in Kenya shillings and as well as invest in US dollars. What happens is once you create an account with Avocap Asset Managers, you deposit your money to the Kenya shillings account or the dollar account, then they will convert the Kenya shillings or the dollar that you have deposited into those accounts to now the South African rand, all right? And at of the making of this particular video, 1 ZAR is equal to 7.25 Kenya shillings. So after you deposit your money, the Kenya shillings amount, into the Kenya shillings account, they are going to give you the rates that they will be using to convert your money now from Kenya shillings to the ZARs, and you're going to agree to the conversion, and then they will convert and do everything else for you, okay? That being said, the minimum investment is 15,000 ZAR, which means that as at today, you would need 15,000 multiplied by 7.25, which gives us 108,750 Kenya shillings. So this is determined by the rate they will give you. So this is a rough estimate because based on the rates that we have for today, that is 7.25, which changes on a daily basis. And in their documentation, they have said that the current minimum investment in Kenya shillings is 111,000 Kenya shillings. That is based on the conversion that they have given, which is around 7 point something. Yes, okay. So the fund has a lock-in period of 6 months. So when you invest, you have to wait for 6 months before you are able to withdraw. After that, you can withdraw the money at any time, and it takes 48 hours for you to get your money into your account, all right, or to the account that you're withdrawing to. Now, our next part that we're going to be discussing here, it's a very important part, especially when it comes to investing in equity funds. And that is, I want us to look at the returns, how you earn. Is the 54% deposited to your account, or how does it work? And I want you to understand this. With all equity funds, you don't actually earn income or interest from this fund, but you buy low and sell high, okay? I want that to sink in. You buy low and sell high with this particular fund. So when you're investing in this particular fund, or when you're going in, you're buying the units at a given price, and you'll be able to see this in the accounts. They have a bid price and an offer price. So when you're going in, you're buying at a particular price, and when you're exiting, you're going to be selling at a different price than what you bought. So this is when you realize the profit, or this is when you know that you have made profit in this particular fund, okay? So you'll be able to see these different prices when you create an account, and they will send you a statement so that you know how the fund is performing, yes? And that being said, I know that this particular fund has not been in the market for a long time, so we don't have a track record to actually rely on. We can only rely on how good the fund is and how good the team is to make us profit when you invest in this particular fund. So I would advise you to make sure that even when you're going in, make sure that you're investing. You have other investments, and whatever you're investing in this particular fund is not all your investment, okay? And when you're going in, make sure that you do, or you are investing, or you're looking at the long term, 3 years and above, so that you can realize the potential of the fund. Because I mean, an equity fund can be, sometimes it's not as stable as other funds, or it's not as safe as other funds like money market funds and things like that. So make sure that when you're going in, you're looking at a long-term investment, and you're investing what you can actually afford to lose. I'm not saying that you're going to lose your money in this particular fund, but it's always good to be cautious, and it's always good to protect your peace and your money, okay? So when you're going in, make sure that you're going in with an amount that is not too much for you. All right, so when you're going in, make sure that you have other investments. This will be an addition or a form of diversification, and you go there for long term so that it also accommodates how the markets are doing, because now we're investing in shares. All right, and now this brings us to the question, how risky is this investment, and can I actually lose my initial capital? This investment is rated as 6, and this is in a scale of 1 to 7, and 1 being low risk and 7 being very high risk, meaning it's a high risk investment. This risk is because of the nature of stocks. Their nature is that stocks are basically volatile, and this exposes the fund to maybe potential losses, and the price of the shares and any income or derived from them may rise or fall. And for the investors, when exiting the market or when withdrawing, you may not get back the exact amount you invested. So when going in, take this into consideration, that it is possible, because it's a high risk investment. It has high potential returns. The fact that we are seeing a 54% return, it also means that it is also a high risk investment. And I remember someone in our previous video asked me whether it's better to invest in shares directly or invest in equity funds. And I'm bringing this aspect because I want us to discuss the risk of investing in an equity fund so that you can relate, okay? So if you're looking at the returns alone, then for shares, then individual shares would offer better returns than an equity fund if you chose the right share. You can invest in a share and then it does a 10x. If it does a 10x and you're in that particular investment, then your investment does a 10x. But the risk of investing in an individual share is actually higher than investing in an equity fund, basically because an equity fund is well diversified as opposed to you owning a single share. So if that particular company that you have invested in, if you had a single share, if that company didn't do well or it went down, it means that you're going to lose all your money in that particular share. But because now an equity fund have diversified across different investments, it means that you're not going to lose a lot of money even when one company does not do well, because now your investment is diversified across different investments. And also remember, this is not just your investments, it's you and 1,000 other people who have invested in that particular share or in that particular fund. So even if the company did not do well, you're going to be sharing this risk as a group, not as an individual. So even if they made a loss of maybe 50%, it will be 50% on the whole fund, not your money, okay? So I think I will do another video to just explain this, because now when it comes to choosing between stocks or individual shares and equity funds, it means that there are a lot of things that you need to consider before going in or before choosing one. And I think we are going to be discussing that in another video, right? So make sure that you stay tuned so that you don't miss out on that. Thank you so much for watching. And if you have any question about this particular fund, make sure that you leave the comments in the comment section, okay? So thank you so much for watching, and bye.